Okay, let us look at this question. Yeah. Using the perpetual inventory system, record the following transaction in the General Journal of Fitzroy Limited, assuming GST does not apply. Number one, purchase 240 units for $220 each on credit. Assume that this is your final exam question. Can you help me to record the first and the second? Second, return 12 units to the supplier. Return 12 units to the supplier. Since the question say on credit, it means that you are going to use account payable. On credit mean account payable. This is account payable, yeah, because you don't make payment. This is your liability. Liability. This is transaction number one and number two. Okay, so your liability increase, your inventory also increase. The second one, account payable. For the second one, your account payable reduce, your inventory also reduce. Please do number one and number two. I'll give you 2 or 3 minutes. Okay, 5 to 800 inventory debit, mashallah, very good. And 5 to 800 account payable credit. That is very good. Yeah, very good. Yeah. How about the second one? You need to multiply 12 multiplies by 220. That gives you 2640. That will very good. Debit account payable 2640. Credit your inventory 2640. So the answer will be like this. Yeah. Inventory increase, debit 5 to 800. Account payable increase. This is your liability. Yeah. Credit by 5 to 800. Okay. That's for the first one. For the second one, when you return 12 units of the inventories to your supplier, your liability will reduce. So you're going to debit your account payable account and you're going to reduce your asset. Your asset also reduce. So mashallah, you did this very well. Okay. How did I get 2640? Let me put the calculation here. This one is 240 multiplied by 220. So that gives you 5280. For the second one, you return 12. So 12 multiplies by 220. So this is the purchase price. So that's why you get 2640. Okay, 26440. Number 3 is sold 5 units of calculators to Mr. A at selling price of $80 each. We sold 5 units of calculators to customer named Mr. A at price of $80 each. Always remember, when you have your sales transaction, we have 2 times. I'm going to, what does it mean by 2 times? It means you have 2 journal entry. Number 1, if, for example, we sold the item on credit, they're not paying us, so we're going to debit our account receivable by 400. How do I get this 400 figure? That is 5 units multiplied by $80 each. This is my revenue or selling price. So that's why I have my cash. If I receive by cash, I'm going to debit my cash. Otherwise, debit account receivable by 400. And I'm going to record this as my sales or my revenue 400. So this is my sales. My sale is 400. This is number one, yeah? Number one. Click number one, step number one. Okay, record your sales. So debit, cash, or account receivable, 400. Credit, sales, 400. Credit, sales, 400. Okay, so this is the first one. The next one, you are going to determine your cost of sale. Okay, once you sold the item to Mr. A, your inventory balance is no more 950. You already, you took out 5 units. This is 20 minus 1. Now, when you sold the inventory, 5 unit of calculators to Mr. A, you're going to minus another 5. 5 multiplied by 50. So I'm going to minus this. I'm going to credit the account receivable. So your new balance now is 700. And I'm going to record this as the cost of sale. So my cost of sale, I'm going to debit. Are you okay with this? When I sold 5 units of inventories to Mr. A, what is the balance? What is the balance? Previously, you purchased 20 units. 20 multiplied by 50. That's why your inventory is 1,000. 20 multiplied by 50. Then you return 1 unit to the supplier. You minus 1. Return to the supplier. 1 multiplied by 50. Then you took out 5 units from the shares. You took out 5 units from the shares. You gave to Mr. A. So what happened to the balance of your inventory? Increase or decrease? When you sold the item to Mr. A, your inventory balance will reduce. How many you sold? 5 units. Sold means you hand over the item to your customer. So I'm going to minus by 5 here. 5 multiplied by 50. So the balance of my inventory is only 700. This is equal to 14. 14 units. Okay. So I'm going to transfer this 250 into cost of sale. It's no more inventory. Now it becomes cost of sale 250. So I'm going to debit the cost of sale account and credit the inventory. I repeat, increase the cost of sale 250 and credit inventory. So now these two items is your income statement item. If you match these two items, it'll give you gross profit. Anyone can help me? The amount of gross profit from this transaction? Gross profit is, thank you so much, is 150. What is your balance of inventory now? Your balance of inventories is only 700. Okay, so we did this for the 400. Now is how we're going to record these two. Okay, so we are going to debit your cost of sales, credit inventory. Cost of sale increase, inventory reduce. Cost of sale increase, your inventory reduce. Okay, always remember for sale transaction, we have 2 times here. We need to have 2 sets of journal entry. What does it mean by gross? This is your sale 400. This is your cost. This is sales for 8 units. This is your cost for 8 units. Not 8 units, 5 units. Sorry, this is for 5 units. And this is also the cost for 5 units. Okay. If you report to your boss, for example, I sold 5 units, the revenue is 400, and the boss asks you, what about the cost? The cost is 250. So from this transaction, you make a gross profit. This is your gross profit 150. What is gross profit? The gross profit is just a sales minus cost of sale. We don't include other expenses, maybe salary, electricity, rental, transportation. Yeah, that is why we call it as gross. Yeah, the gross mean they don't include other expenses yet. For example, you need to calculate the cost of electricity, the salesman salary. Okay, if you minus all the costs, it become net profit. Net profit. The gross mean just sale and cost of sales. That's why we have gross profit. So what is the transaction, the journal entry? Debit, cost of sales, and credit inventory. Credit inventory means minus your inventory. This is transaction number 3. Transaction number 4, the last part. This is the last one, yeah, for the first part. Okay. Mr. A returned 1 unit of calculator. 1 unit of calculator. We sold to him before this at price of 80. The cost is 50. So how are we going to record this? How are we going to record this? Okay. When he returned the item, okay, when Mr. A returned 1 unit of calculator to you, okay, if you receive the payment before this by cash, then you need to return back the cash for the payment for 1 unit of inventory. Yeah. Otherwise, if your customer, sorry, this is your per sales. If your customer before this purchase the calculator on credit, they'll become your account receivable. They become your account receivable. When they return the item to you, you're going to reduce their account receivable. Yeah, you're going to reduce the account receivable. If before this, they make payment by cash, so you're going to reimburse back, you're going to return the money back to them because they returned the item to us. So for the first part, you're going to record the return. Okay, the selling price is 80. So you're going to return the cash, or going to reduce the account receivable by 80. So this is the first one. And what happened to your sales? Your sale reduced. Instead of 400, your total sale will be 320. Why? The customer returned one item to you. So to add value to accounting to this information, we create another account. We call it as sales, return, and allowances. This is a contra account. Contra account. So our original sale is 400, still 400. Now we have a return of 80. So I'm debiting. This is the credit account. This is a debit account. So we need to debit our sales and return allowance account by 80. So this is debit, this is credit. Okay. When you prepare your income statement later on, you're going to report the net sales. The net sale. How much is your net sales? Your net sale will be 400 minus 80. Yeah, that is 320. Okay, so for sales return, the first adjustment journal entry will be debit, sales return, and allowances, credit, cash, or account receivable by 80. When they return the goods to you, 1 unit of calculator, what happened to your calculators? Stop. It will increase. It will increase. You purchase 20, return 1, sold 5, and then you sold 5, and then you get return back 1. So your inventory balance increase. All right. So this will be debit. What happened to your cost of sales? Your cost of sale will reduce because your sale reduce, your cost of sale also reduce. So you're going to minus, I'm going to credit my cost of sale by 50. This net sales, 400 minus 8 is for how many unit? 5 minus 1 unit. For this is for 5 minus 1 units. Yeah, 4. And the cost, then you less the cost of sale. The cost of sale will be 200. This is 4 multiplied by 50. So your gross profit now is 120. So this is your gross profit, 120. So for sales return and allowances, always remember the first one you're going to do is you're going to reimburse the cash payment, cash receipt, or you're going to reduce your account receivable. You're going to credit your account receivable or cash, debit your sales return and allowances. This is the first one. The second one, the second part is to record the additional inventory. There is one unit of inventory that was 50. So your total inventory now should be 1,000. It should be 750. I think it should be 750. So that is your inventory balance. The transaction will be debit inventories, credit cost of sale. Debit inventory, credit cost of sale. So this is reduce, this is reduce, so credit. This is increase in inventory asset, debit. Debit. Let us see this example from your tutorial. Yeah, you sold 48 unit. Sold 48 unit for 380 on credit. On credit. Yeah, on credit. So you should have two transactions here. This is for sales for number 1 and number 2. Number 1, record the sales. Number 2, you need to adjust your cost of sale and inventory. Okay, please take your time to see whether you can solve this or not. Yeah, sold 48 units for 380 each on credit. On credit mean your account receivable. What happened to your account receivable? Your account receivable will increase, debit. What is the amount? 48 multiplied by 380. That is your selling price. 18,240. Okay. And then you're going to record your revenue. This is your revenue, sales, credit by 18,240. Second, once you sold the item to your customer, your inventory level will reduce. So inventory, I'm going to reduce your inventory, credit, and I'm going to increase the cost of sale. This is for 48 unit. The cost for you is 220. So it's going to be your cost debit will be 10,560 and going to credit your inventory by 10,560. How do I get this? This is 48 unit plus the cost is not plus, multiply the cost of $20, $220 each. So this is for sales. For sales.
Professor?
Okay, let us do adjustment number 5, that is about sales return and allowances. When our customer returns 6 units, that purchase in number 3, we're going to reduce the account receivable. When they return the item, the account receivable, we're going to reduce the account receivable. So account receivable, to reduce, you're going to credit your account receivable. This one is debit. Now you're crediting your account receivable. What is the amount? 6 multiplied by 360, that gives you 2280. So you're going to put here 2280. And then for the sales, the reverse or the contra account for sale, we have a special account, we call it as sales return and allowances. This is debit by the same amount, 2280. Okay, we did for number 1. Let us do for, this is for the sales. Let us do for the cost. For the cost and inventory, when our customer return the item to us, what happened is our inventory will increase. So our inventory, okay, before this is credit, increase mean debit. The amount will be 6 unit multiplied by, what is the cost? 220-ish. So 1320. And the cost of sales, COS, the cost will reduce because the sale was cancelled by 6 unit. So credit 1320. How did I get this number? This one is 6 multiplied by 380, and the cost is 6 multiplied by 220. So sales return, reduce in sale, reduce in account receivable, increase in inventory, reduce in cost. So this is answer for adjustment number 5. Adjustment number